Hey, what's up, YouTube? Welcome to Super Stock Bros. My name is Ace, and today I'm going to be talking to you about how to make 5% a month in the market and why the 10% is aggressive idea is a total myth. All right, so the first thing I wanted to talk to you about is why is the 10% is aggressive idea a myth? Well, it's one of the first things you hear when you enter the market. 10% returns from the market is aggressive. The most you can expect is 8% or even 10%, but you might get lucky that year. You know, I don't think that's true at all. I think this is actually total BS. That's what they say to people that are either, way too rich. Like if you have billions of dollars to manage, 10% is great. Who cares? You'll make $1 billion. Good for you. Like if you have a ton of money, that's probably the best move. Just dump it into a bunch of index funds or something like that, right? But for the average retail investor that has like 100K or 50K or 10K, you can make easily 60% a year, very, very easily. And that's because you have more fluidity with what you can do. You're more liquid. You can't take that many risks when you have a ton of money. And by ton, I mean like over $100 million, because guess what? It's too much risk. You don't want to risk that much. The name of the game at that point is reduce your risk. So this idea of the 10% is aggressive. It's not meant for people like you and I. It's meant for the billionaires. Okay. So what can you expect? What are the returns you can expect? Well, first, let's talk about what you need to do. Okay. We're not talking about gambling here. We're talking about a safe, consistent return, because if you have a safe, consistent return, you can turn 10,000 into a million in 20 plays. Okay. Now, what are we talking about? We're talking about long-term wins. So first, you got to build up a portfolio. Okay. What do I mean by portfolio? I mean buy the stocks that you love, the shares that you love. So, for example, Apple, buy 100 Apple shares. Microsoft, buy 100 Microsoft shares. I'm a tech guy. I love that stuff. I know that they're going to be around for basically forever. So you buy shares of those. Anything that you think is going to survive for the next 10 years, you should probably buy that company's shares. Now, what's a good judge of this? Think about things that you use: Amazon, Microsoft products, Apple products. These things are going to be around for a long time. Okay. Walmart, stuff like that. So you want to buy denominations of 100 shares if you can, or like slowly build up to that point, buy like 20 at a time. And then you have a very strong portfolio. Try to, put like 10% of the amount that you earn a month into the market and slowly buy up the shares. Buy especially on dip days, for example, like when the market goes down 5%, you should buy 5 shares. When it goes down 10%, buy 10 shares. Stuff like that. All right. And you're looking for good opportunities to get in. Try not to buy at the high, but who knows? New highs are being made every single day. So, sometimes you just got to get in. It's a very, very common quote that I hear, and this actually comes from the Bible, but it's repeated by one of the stock channels that I follow. Farmer never plants if he waits for perfection, right? So just go ahead and invest. The common rule is it's not about timing the market, it's about time in the market. Okay, so long-term wins. Let's just settle that right now. So what's an example of this? Like some people say, what if I got in 2009 or 2008 when everything was dipping really low? Well, let me show you a graph here that shows why the long term wins. Okay, so this is very well known, and I just have to say it so that I can convince everyone that the long term is the winner. No matter whether you have a down year or up year, in the long run, you're going to make money. Okay, so this is a graph from 1871 to 2017. The cumulative average growth rate is going to be about 6.9%. Okay, so you're going to go up in the long term. You just have to hold. Don't sell when you are like, don't panic sell. Don't sell when you're at a loss at the moment, because it's always going to go back up. Especially if you remember our rule, if the company is around for 10 years, then you shouldn't worry about 1 year, for example. This return lasts even from 1871 to 2017 here, and even from 2000 to 2019, you have 8.87%. So it's going to work out, all right? But what I want to tell you today is you can make more money on top of that, okay? So that was the long term. Long term is good. Establish your long term. This is the first thing that you need to do. Don't gamble on options to build up your long term. Just buy your shares and then you can think about what to do with extra money that you have, for example. Okay, so like we said, long-term wins. Now, what can you do once you've established a long-term portfolio? Well, now you can leverage your dormant portfolio if it's dormant. Okay, so for example, you buy your shares, you do great, you have a bunch of companies that you're confident in, and everything's looking good. What's the next step? A lot of people stop here. You can sit on it, you can do nothing, but I'm here to tell you that you can make extra money by doing things like selling covered calls. Now, I'm not going to explain what that is in this video. I'll make a video in the future, but for now, check out the description for a link to a video by the YouTube channel In the Money. This guy, a very smart guy. He did a great video on covered calls. I've linked it in the source below, so check that out. But what I'm going to do to show you next is an example of the play that I made today, January 19th. So let's check that out. Okay, so here's an example play. We're going to be covering what I did today, January 19th. And what I did was I sold covered calls on my Palantir shares. Okay, so I own Palantir, sticking to the strategy of having a strongly built portfolio. I think Palantir is going to be here for 10 years. I think that it is a company with a strong management group, a good CEO. They have a good product, especially looking at the demos on their site recently. Looking forward to the demo conference coming up. They also have a pretty great vision, and I think they do have a bunch of connections, so they can leverage their product. They can sell it, and after it's built. So they built it, now they can actually sell it. It's the recipe for a great company. Now, I have that in my portfolio. So right now, Palantir is kind of just fluctuating between 22 and 28-ish. And what I want to do is now sell covered calls as it's fluctuating. So in this example, I have 300 shares. So I sold 3 contracts with a 31 days to expire. Okay, so that's because it's January 19th right now. It's 31 days till expiry at February 19th. Okay, so that means I just made 5.18% on my money in 31 days. Okay, so how did I come up to that number? Well, I got $394.25, and my initial position, which you can see here, is 2,600. So then I had an average of 5.18%. Okay, so I just made 5% in a month because remember, date to expiry is 31 days. Now you might be asking, okay, so you only did that with 7,600. Okay. Well, you can scale this infinitely. Say you had $760,000 or $76,000 in your portfolio, and it was all in Palantir for some reason. Well, then you can have earned a multiple of that, right? So if I had, 76,000, then I could have sold this for $3,942.50. Okay, because it scales. It's just 10x this, both sides. Okay, so and then I would sell 30 contracts instead of 3 contracts. And there you have it, 5.18% in 1 month. Okay. And now remember, the claim was that you can only make 10% in 1 year, and that's aggressive. Well, I just showed you how to make 5% in 1 month. So this is not an aggressive move. This is actually fairly standard in the options world to sell a covered call. In fact, if you imagine that I made this 5.18% every single month for 12 months, what's my cumulative average? Well, it's even easy math, right? So let's just multiply this by 12. I'm making 62.25% a year. This is cumulative. This is the annualized return. Okay. So this rate is not guaranteed, on a month-to-month basis, 5.81%. You might not make that month-to-month, but at the same time, you can see the power that you have in the options that you have in order to make money on your dormant portfolio, right? A lot of people just have these shares sitting around. Well, I not only have them sitting around, I'm making money on them. And there you go. This is a low risk way to achieve your goal of, it could be 5%, 10% on your shares a year for money that you would have otherwise not been making. These shares would have just been sitting around. So there you go. I hope that dispels the 10% is risky myth, because guess what? You could just do these for 2 months and you make your 10%. Okay, so I think that explains the power that you have with the shares in your portfolio. So you can do a lot more than you think. And you know what? Doing something like this is going to make you a ton of money if you do it right. So, stock bros, let's make those gains.